right, good morning, everybody. Can you hear me? Okay, thanks, Rich G. Linda, Lyndon, Natalie, John C., Jazz B., Ricky B. We got a Jazz B and a Ricky B. DG, Lauren, Eddie, everybody, Jamie. Hey, Jamie, how are you? Harry? All right, well, thanks for coming in, you guys. Look, it's a pretty crowded weekend for webinars from what I heard and or from what I know. And what, real quick, I would just want to explain about, if you don't know who MrTopStep is, who we are. One thing that we're not is we're not a broker. We're not out to ask you to clear your business with us. In fact, we don't want to. If you've got a question about a clearing, relationship, we can point you in that direction. But we really don't know anybody particular. We can tell you firms, but we can't tell you brokers. We stay away from that because we're traders, and traders, when you mix those two up, it gets a little bit crazy, and we want to be away from that. But anyways, long story short, we started MrTopStep about 5 or 6 years ago with John Nigerian and Company, and it was called Futures Monster at the time. And I did all these videos on the floor, and then one day, about a year and a half worth of videos, and one day I asked John what I was doing, and he really couldn't tell me what we were doing. But I had a vision very early on, on the trading floor as electronic trading took over and the floor got quieter, that there was an opportunity to go out and kind of share some of the things that we've learned or I've learned on the trading floor. And as I did that, more people kind of jumped on board. And I was thinking this morning, at one point before the credit crisis took over, we had something on our trading desk called Pivot. It's a very, very large instant messaging service. And we had over 500, we had 500 to 600, I can't tell you exactly, banks, prop firms, hedge funds, investment firms, individual traders, etc., all rolled into one instant message. It was very powerful. And when the S&Ps were moving around and, the premium levels were jumping around and we'd be hitting buy stops and, because I've got a program trading background, I used to kind of chime out on the instant message, sell programs, stops. And a lot of this, a lot of traders are not kind of seeing that stuff coming live from the floor. But as I did that, I added a couple of people. I met Kathy Garber, and I met Frank, and I met Jack Bros, and I met Stuart from Chicago Stock, all very, very good traders. And what I lacked, they had. I had the floor experience and the knowledge of order flow and how things work on the trading floor, and I had very, very little background in charts. I was a big order taker. That's what I was. I put in 1,000 lot, 3,000 lot S&P orders. We move the markets all the time, and really, to tell you the truth, our desk, I don't care what anybody says, according to CME Merck's volume statistics, we did more execution and more business than any desk in the S&P history. And if you ask me why, I tell you very briefly, we didn't trade our own accounts. We weren't dual trading. We weren't down there. We were down there with the best intent to try to get the best fill for the customer, where there were a lot of outside circumstances, the dual trading and, people front running, and we fought that, and that's why we got the business. But anyways, I'm going to kind of quicken this up a little bit. People ask me why I do this, and I'm going to tell you, I don't get paid at MrTopStep. I do this because I love what I do. I love meeting people. I love sharing experiences. Can I talk a little louder? Hold on. I don't know if I can. Is everybody can hear? Can you guys hear? Good. Okay. But anyways, good. Anyways, I think you guys will agree that trading used to be, something that guys would do kind of on their own. A trader would sit at home, he'd have CNBC on, he'd have his charts up, he'd have a couple markets he likes to follow, and that would basically be the way he does it. Or what we believe in is that term, don't trade in a closet, that if you put people together it becomes more of a, you know, you get more information, and we see. I'm not kidding. We beat CNBC on so many news items every day of the week. It's silly. But that said, we put all this together, and I'm going to be very quick about this. And Marlon Cobb, I want to thank him very much. He's one of the partners at MrTopStep, and he built a trading room that we moved everybody into. And in the trading room, it's an open forum. And in the beginning, we had a couple of traders that ran the room. You know, Kathy would do it and Frank would do it, and you know, but like anything, it gets hard to do all day long. You know, they can make winning trades, and you sit there and you pound it out all day long, and by the end of the day, everybody's kind of tired. And if you do it for a couple of years, people are really tired. So I went back to Marlon about 6 months ago, and I said, Marlon, isn't there a way that you could create a trading room where we would have like a lounge, like our main trading room, where everybody would filter in, and then Kathy could have her own separate room, and Randall could have, you know, the options room, and could have their own room. Randall could have his room, and then, you know, Pivot Boss could have his room, and all rolled up into one thing, all rolled up into one template. And we've created that, and Marlon, we're just getting down to the finites of it, and we're starting to load people in. But I'm going to tell you something. I don't believe that there's one guy out there can call the market all the time. I just don't believe it. I know that there's people that boast that they've got a product that makes money every day. I don't know. I work for the Pitbull, Marty Schwartz, and he's a guy that makes money almost every day. But he doesn't make money every day, and he'll tell you that. And I just don't know too many people that do. But that said, you guys, what we did is we went back to the drawing board. We rewrote the room. Now, when you come into our room, if you want, you can come in and you can stay in the main lounge. If you want to go see what Randall's talking about in the options room with you know, with the other two partners, Jamie and Tim Evans, they're not going to be talking here, but they are here today, and they can add as we go along. Or if you want to, you know, go and see what Pivot Boss, or if you want to go see what Chicago stock, right? It's very, very cool. It really, really is. And I'm very, very proud of it, and I'm excited about the future of it. But anyways, listen, I've talked for a couple minutes here. I want to explain something really quick, and this is a true story. When I met Randall, I knew he was someone that I wanted to be around. I know he's a very, very smart man. Option guys tend to be that way. They tend to be kind of smarter than, you know, kind of be smart guys. We're a futures trader. I'm not knocking the futures trader, don't get me wrong. But there seems to be a little bit more involved in the options side of things. It seems to be broader. And I've always liked options because, one, I was never that good at them. But a couple of weeks ago, or after not a couple of weeks ago, this is right before the August expiration last month. After the S&P sold off, as it was selling off, I didn't catch a sell-off in the futures, so I started to look for a buying opportunity. I didn't think that the S&P was going to get killed when we sold off to what, 1891.75. Wasn't that the low? 1891.75. I didn't think we were going to get killed when we sold off. I admit that it was a sharp sell-off, but I'm kind of a permable. If you guys know me, you know that I like the long side. And I've stayed that way pretty much for the last 3 years. And I'll admit I've fallen off my wagon a couple of times, but I'll tell you what, as soon as the SPOOs start going against me and I'm short, I get the hell out of the way because I know that there's a new high coming in here somewhere. But that said, I missed the short in the S&P, so I started accumulating some calls. I bought the August calls. I bought the August 2020 calls. And I was right on. But you know what? The calls became worthless. They went out worthless. Even though the futures rallied, time decay attacked those calls. Now, one of the things that I had talked to Randall about is he's done the same thing. And I went to Randall and I said, Randall, you know, if I had done this, he said, well, Danny, you bought the calls too close to the expiration if you had bought the Septembers. And I went back and I looked at the Septembers, and I don't even want to tell you how much money I would have made. It's almost silly. I mean, I was risking $2,500, and I easily could have made $30,000 to $50,000 on that trade if I had held on to them. And I'm not saying I would have, and I'm not. But I'm sure after they won 10 grand my way, I would have been starting to get out of them. But just to know that I had that right idea, but I had the wrong strike prices in the wrong months, and had I risked a little bit more, I could have made a lot of money. So futures trading's hard, and I believe that it was the August 2020 calls, and I started buying them like at 0.45, 0.35. I think 0.35, 0.45. I bought them all the way down, and I had an average of like 0.25 or 0.35, but they went out worthless. If you look back and you look at the Septembers, you'll find out that about even going into the expiration, into that right after that next week, the futures took off on the upside, and I would have been golden. But anyways, you can't talk about trades that could have been, because we only deal in the here and now, and it's all dollars and cents here. But anyways, listen, I'm going to turn the headset over to Randall Liss, and I want to thank everybody for coming in today. And it's going to be a good one, because Randall's a good one. Anyways, I wanted to put the headset on today, but the headset did not work, and the camera, and anyways, that's that, and I'll be back on after Randall talks if you guys want to stick around a little bit. Thank you very much.
Thanks, Dan. Hey folks, how's everybody doing out there? It's a chilly morning here in beautiful Chicago. If anyone has trouble hearing me, please say so. I normally speak pretty loud. I'm going to talk about myself just for a little bit here, to introduce myself and then get right into what I'm talking about, what I want to talk about today. My name is Randall Liss. My site is www.thelissreport.com, where you can see a little bit more about me. I was a market maker on the floor of the European Options Exchange in Amsterdam for more than 25 years. When the European Options Exchange went screen-based, and unlike here, where the floor is basically dying the death of 1,000 cuts, in Amsterdam they went big bang. October expiration was open outcry. There was no more floor. Trading after that was on the screen. After that, I decided to get full-time into options education. I'm also adjunct faculty at Columbia College here in Chicago. I enjoy the transfer of knowledge very, very much. Now, before I get into actually what I want to talk about, I do have to say the following disclaimer. I am not a financial advisor. I'm not a market prognosticator. I don't know if we're going up or down. I don't have a clue. I'm an options educator. What I'm here to do is to teach you a way of thinking about options, a way to use options to translate your view into a good, solid risk versus reward strategy. So don't ask me if I think this is going up or down, because I don't know. I don't have any dog in this hunt. I'm not a broker. I'm an educator. I even very seldom trade these days. I transfer my accumulated knowledge. So that's what I'm doing here. I want to help you figure out a way to use options to aid your investment views. Yes, the webinar is being recorded. Okay, to answer Steve B's question. By the way, go ahead and ask questions if you want, but I'm gonna hold off till after I'm done talking and then answer all the questions instead of interrupting the flow by taking the questions one at a time. But I do like questions. Questions are very, very important, because sometimes I may not get my point across in the correct way, and I'll explain it as long as it takes. So ask as many questions as you like. Okay. What we're going to talk about is three-dimensional option trading. And as I say, that's my website. Please take a look at it. I do write about options and the market every business day, and I do lessons. If you're in the Chicago area, I will come to your home or office. If you're outside the Chicago area, I do these lessons virtually. Using GoToMeeting.com. All right. It is often easier to tell what will happen to the price of a stock rather than how much time will elapse before it happens. An old stock guy named Phil Fisher wrote those words in 1909, and they are still true today. I'll give you an example. For a year now, people have been talking, the correction's going to come, the correction's going to come. 8 to 10% sell-off, it's inevitable. But no one was able to say when. Well, now we're getting some downside move, but nobody still is saying, is this it? Because every downside move has been a buying opportunity up till now. And one of these days, people are going to buy the dip and it's going to keep going down. So it's not so much the direction. We all know that the market is frothy. Everybody knows the market is frothy. So the direction part is easy, but you have to consider 3 dimensions. The single biggest complaint I get from novice traders or novice investors goes along the lines of, I was sure the stock was going higher, I bought the calls, the stock went higher, and I still lost money. How did that happen? Very similar to the story Danny just related. That's because only one direction, or dimension rather, only one dimension was considered. That dimension is the direction, the what. But you have to consider all 3 dimensions. The 3 dimensions are direction, the what, time, the when, and the velocity, the how fast. 3-dimensional options trading. If you don't consider all 3, it makes it very, very difficult to make money. Direction, or the lack thereof. Don't forget, stocks and indices not only go higher or lower, they often move sideways, and sometimes for a great deal of time. Sideways is a direction as well. It's not just up or down, it's also sideways. So direction is the what, is your first consideration. Now let me get into why I trade options, why I'm an options guy. Because I like to spread. I like to limit my risk versus my reward. I've never been a futures person or a day trader. I don't just buy it because I see some point on the chart or sell it because I see some point on the chart. I'll do a spread. Yes, the spread will cap my upside potential, but it will also well define my risk. For that reason, when trading options, I don't like to buy them outright, and I don't like to sell them outright. I don't like to buy them outright because, as Danny noted in his example, time decay is a killer. Options are a wasting asset, and time decay happens when the market is open or closed. On the weekend, on the holiday, options decay. And if the option decays faster than your direction, you're going to lose money. I don't like to sell options outright because the most I can make is the premium I can ship in, and I have a potentially unlimited risk. Another reason I'm an options guy is I don't believe in unlimited risk. I always tell the traders I mentor, if you're thinking about a position, I want you to tell me the most you can lose if it blows up in your face. And if the most you can lose is unlimited, then I say you better not do that position. I don't like unlimited loss potential, which is why I spread. So we're going to be talking in our examples here, we're talking about options spreading. Not just buy the call and hope it goes up, or sell the straddle and hope it stays unchanged. No. We're going to talk about options spreading. So, dimension 1, direction. What? What is going to happen? And perhaps nothing is going to happen. That's also a direction. And the beauty of options is you can also use that time decay to your advantage. Now, time, it's duration. Duration. It's not just when this move is going to happen. For instance, is the great correction upon us now? Is when now? Fine. How long is this going to go? Is this going to be really over really, really quickly? Or was this move going to stretch itself out for a while? And also think, will a move be pre or post event? For instance, we have a big Fed meeting coming up, and everybody's looking at that for signs that the Fed might somehow change their policy. Everyone wants to read the Fed's tea leaves, as it were. So are we going to get that move now? Is that move happening pre-event? Or will the move happen post-event? Very, very often, the market is very volatile, or a stock is very volatile ahead of an event, be it a press conference or an earnings announcement or an economic figure. And then bang, the event happens, and it's totally priced into the stock, and nothing happens. So sometimes the move happens pre-event, sometimes the move happens post-event. If you believe that the move is going to be short-term, bang, use short-term options. If you believe the move is not going to happen this day, then go out a little while. By the way, right, wrong, or indifferent, I strongly advise, I recommend that you do not carry an option position until expiration day. I think unless you're a very sharp professional trader, you should be out of your positions by Thursday of expiration week at the very latest. The pros play a lot of games on expiration, and you don't want to get caught up in that. Besides, if you put on a position 3 weeks ago, it either has worked or it hasn't worked by expiration week. So don't wait until the last dog is dead. And yes, if that means buying back a short option at 5 cents, so what? You sold it higher. Don't be greedy. Now, I do see a question here from Greg H., and I will answer it real quick. Is there any way to limit the risk of one side of a spread being assigned? Well, that's an early assignment as a lesson in itself. But here's a quick answer. If you use European-style index options, like the SPX or the Russell, there is no early exercise. So you don't have to ever worry about it. Yes, in deep in the money puts and calls on individual stocks, early assignment is a big risk, but that's a whole other lesson in and of itself. All right. Short-term move, short-term option. If you think the move's going to happen later on, use later on dated options. Okay, let's look at some examples. Let's say you have a really high level of conviction. Let's say you think, the XYZ stock, it's at 85 and you think it's going to 100. Your price target should always be the option you are short, not the option you are long. Don't forget, the 100 call is still worthless with the stock at 100. So your price target is your short option, not your long option. XYZ is at 85. You think it's going to 100. You do not want to buy the 100 call. You want to sell the 100 call. So you buy the 90-100 vertical call spread. Notice I don't say just go buy the 90 calls. No, I don't like that. I say do the vertical spread. Yes, it will cap your upside potential. The most the 90-100 call spread can ever be worth, no matter where the stock is 10. All right, well and good. It caps your upside potential, but it also greatly lessens your risk, particularly in terms of time decay. Let's say you have a lower level of conviction. I like buying an out-of-the-money butterfly with the short middle strike at my price target. Now, once again, I don't know what your option jargon is out there, so if I say terms like, the butterfly, and you don't know what that is, perhaps you can say so. But basically, a butterfly is your long, one time, one call, your short, 2 times, the next call, and your long again, 1 time, the call above it. Your strike prices must be equidistant from each other. you could actually look at the butterfly as a combination of two vertical spreads. Let's say this is strike A, this is strike B, and this is strike C. Your long vertical spread AB, your short vertical spread BC. So your ideal expiration is right on strike B. That means long vertical spread AB goes out at maximum value, short vertical spread BC goes out worthless. So your price target is strike B. Once again, you're short the option at your price target. Never be long an option at your price target. That's the option you want to be short. I do a whole series of lectures on butterflies because it's one of my absolute favorite option strategies. Very good risk-reward ratio. But briefly, when doing a butterfly, I do not like to pay more than 10% of the strike differential. So I'll pay $1 for a butterfly if the strike intervals is 10 bucks, 50 cents if the strike intervals is 5 bucks, and so on. If you do that, it gives you a very nice 1-to-9 risk-reward ratio. Excuse me. So, if I have a lesser level of conviction, hang on a second, how do I erase this? Let me just see there. Whoops. Hey, John, how do I erase my drawings? What X? Excuse me. Just working this out here. I normally use GoToMeeting. There we go. Thank you. So, this is my first webinar for MrTopStep, so, you know, getting used to the technology. Sorry about that. So I have a lower level of conviction. I will do a 1 versus 9 risk-reward ratio trade and buy a butterfly with the out-of-the-money butterfly with the short strike being my target price. What if I think we're going to drift? What if I think we're going to drift? Then I'm looking to do a collar. A collar is long the underlying value, long the out-of-the-money put, short the out-of-the-money call. That way, the short out-of-the-money call finances the long out-of-the-money put. I've collared the stock. I'm protected. I know what I can lose. It's much better than just buying the stock, and much better than just doing a covered write, because a covered write doesn't give you sufficient downside protection. Now, the last dimension of the 3 is very, very important. Velocity, the speed. Options are very, very dependent on the perceived velocity of the move. How volatile. Volatility is a huge, huge, huge factor in the price of an option. It's also the hardest one to predict. So you really need to consider velocity when you're considering your strategy. For instance, do you think this correction that's been mooted for so long, do you think it's underway now, and is it going to accelerate? Are we going to get some serious puking next week? Or do you think, no, it's going to just like sidestep down? It's just going to go down a point or so at a time for days. That will have a very big influence on the strategies you should choose. A strong move down tends to increase implied volatility. A strong move up tends to crush implied volatility, and any sideways move will crush implied volatility. This is for a couple reasons. Reason 1 is the really mega big moves we've seen, or certainly I've seen in my career, have all been to the downside. I have almost never seen a seriously explosive move up in the market as a whole. That's not true for individual stocks, of course. You can get a takeover bid or an earnings surprise. And even then, a big move up will tend to crush implied volatility, just like any sideways move. But a big move down will tend to explode implied volatility. And keep in mind, there's two sorts of volatility. When I talk about implied volatility, there's also historical volatility. Historical volatility is quite simply what the volatility was in the past, looking backward. Implied volatility is what the market, in its wisdom of supply and demand, thinks the volatility will be. Now, if implied volatility explodes, you can be wrong and still make, or in any case, lose less money. I'll give you an example. Another trade I like to do if I really think a stock can explosively go higher, I like to do what's called a bullish back spread. I will buy 10 out of the money calls, and I will finance that by selling one in the money call. Normally this is cash neutral, but if the stock explodes higher, obviously I have 9 extra calls, so I make a boatload of money. Now, let's say the stock crashes, but implied volatility explodes. That means my long out of the money calls are going to be very sticky going down. They might not even go down at all, or just fractionally, or nowhere near as much as that in the money call or the stock went down. So an explosion in implied volatility can help keep you from losing money in this position. So in this case, your worst case scenario in this trade would be if you were wrong on velocity and the market, the stock just crept up slightly higher, so your 10 out of the money calls went out worthless, but that one in the money call was higher. So that's your worst case scenario. Your worst case scenario, even though this is a bullish trade, is not a big puke in the stock, because the explosion in implied volatility that comes with that can very often offset your loss. Another thing why you really want to look at your historical volatility before you make these decisions versus the implied volatility is that implied volatility has a strong tendency to revert over time to the historical mean. This is particularly true if the implied volatility is under the historical mean volatility. I don't get into a lot of statistics and formulas and such, it's not my style. We call this mean reversion. And it very, very often happens. And we see here that JC is talking that in the flash crash, he had a bullish put spread. I take that that's a short put spread. And IBM went down, but his bullish position made money because of the spike in volatility. Yes, we all remember the flash crash. The worst thing that happened to people I know on flash crash is they, if they had accounts with institutional brokers that did auto liquidate, they didn't give you a margin call, they just liquidated your position. Well, very often at the low. But that's neither here nor there. But yeah, you know, you get 3 traders in a room together and you're going to get 50 trading stories. Anyway, so you really want to always look at your historical volatility. And if the implied volatility is higher than the historical volatility, I would be hesitant to buy a lot of option premium, to buy a lot of volatility, because you're very likely going to get a mean reversion back to the historical volatility. However, if the implied volatility, because the stock or the market has been dormant for a good length of time, is under the historical volatility, then I have a high level of confidence in buying option premium, buying option volatility. Now, another beautiful thing about options is you can have it both ways. We call that first this, then that. And using calendar spreads, either time or horizontal calendar spreads, are a great way to trade both directions. You want your short leg to expire worthless, and that helps offset the cost of the long leg. For instance, let's say you think, you know what, this market is going to drift lower, the sellers are going to exhaust themselves, and it's going to pop higher. then you want to be a seller of the short-term calls and a buyer of the further-term calls. So your short calls go out worthless, and you have your long calls for next to nothing. Remember, a time spread is if it's a horizontal time spread, it's the same strike, different months. You sell the front month and you buy a further out month at the same strike. You want your short leg to go out worthless, so your long leg is very, very cheap. Here's a real-life example. Now, this is an old slide. Geez, it's almost a year old. Good grief. Anyway, remember, I'm teaching a way to think about options, a way to think about options. I'm not showing exact strategies. So even though these Apple prices are way outdated, the illustration is helpful because it shows a way of thinking about the options. Let's say it was October 28th, 2013. These were real prices then. The premise was, let's say, that Apple will just drift and then have a stunning year-end rally. So you could sell the November 550 call at 950, and you can buy the December 570 call at 10. Now, in this example, this is a diagonal calendar spread. A diagonal calendar spread because it has different strikes. You notice we sell the Nov 550 call at 950. We buy the December 570 call at 10. With Apple below 550 at the November expiration, I have an actual net purchase price of the December 570 call of only 50 cents, not 10 bucks. So that's the first this, then that in this scenario. Apple will drift and then rally. So I want to own December calls as cheaply as possible. I do this by selling a shorter term call to offset it. Once again, the beauty of spreading. I mean, if I just bought that December 570 call at 10 bucks and Apple did rally at the end of the year, I still might not make any money. But if I have that same December 570 call for only 50 cents, well, what the heck? I'm only risking 50 cents. An ETF I like because it's very, very liquid with very, very tight markets is the Spider SPY. It mirrors the S&P 500. It's very, very liquid, very easy product to trade. If you want to trade the market as a whole, those are the options I like. I even prefer them to the SPX because the SPX tends to get a little more manipulated. The SPY, though, is American style, so you do need to keep your eye on your deep in the monies. So let's say my premise back in October then was the market would rally toward year end, but then the New Year's rally would not materialize and the market would puke in January. Let's say that's my premise. Slightly higher than a puke. So I could have sold the Nov 175 put at $1.50 and bought the Jan 165 put at the same $1.50. In traders' parlance, we call this doing the spread for even money. Any sort of move or settlement price above 175 means that Jan 165 put is free. And I don't care if you're bullish or bearish, free options are a nice thing to have. So, in conclusion, before we get to any questions here, in conclusion, it's never just the what. The what is often easy. It's the when and the how fast. When is the move going to happen, and is it going to be a sharp, swift move or a slow grind move? Three-dimensional options trading. You must and I underline it again, you must consider all three dimensions when looking at any position you want to put on. So, are there questions out there for anyone? I can go through the slides again, or Randall, Charles R. says, based on your professional experience, can you describe the games played at options expiration by market makers? Well, first of all, market makers love to pin the underlying value at the strike price with the greatest open interest, which they're normally short. So that's a very good indicator that if there's an option with a very large open interest, that's not the option you want to be long, because they're probably going to try and pin the underlying value there. Also, on expiration, there's a great deal of volatility as everyone's trying to square off their positions. There's not a lot of fundamental actions at play here. So aside from pin risk, you get a lot of volatility that really has nothing to do with the product itself. And if you're not a professional trader, I really think you should not even be in there. As I said, your position is either worked or not. Look at open interest. Keep an eye on open interest. More often than not, the underlying value will settle at the strike price with the highest open interest. A favorite tool to analyze spread outcomes. Well, you know, it's really not that tough. If I pay $2 for a $10 vertical spread, I can make 8 and lose 2. I don't need to really deeply analyze it. I mean, I'm assuming you're not all market makers out there with positions in 85 different series, so you have to run huge theoretical value outcomes. When I was a market maker, I did that. But if I do a butterfly and I pay 25 cents for a 250 butterfly, it's a one, you know, that's my risk-reward ratio. I don't believe in overanalyzing this stuff. I believe in keeping it simple. Simplify, demystify. Rudy asks, in equity, which is the most important in the options, chain volume or open interest? First of all, one begets the other. Having said that, stay away from options with a very low open interest. You don't want to be the open interest in something. I believe in trading liquid products. So yes, volume is important, but the two are tightly interlinked, as large open interest begets large volume. Charles asks, how often do I use gamma scalping as a general overview of gamma? All right, gamma scalping. First, gamma is one of the Greeks. It is basically how much delta you make or lose for a 1-point move in the underlying value. So an example of gamma scalping would be to buy the at-the-money straddle and then adjust as your delta changes. The problem with that is you can lose a lot of money if the move doesn't happen. So gamma scalping, not a big fan. I'll put on a position, for instance, an iron butterfly, which is sort of gamma trading. Iron butterfly is short the at-the-money straddle, long the out-of-the-money call, long the out-of-the-money put. Another whole lesson in itself. Do I control my positions with theta consideration, asks Stephen R. Yes, I like to have the clock on my side. Having said that, I don't like to be net options short. So that example I said before of the iron butterfly is a great example of being actually long some gamma, but also long a little theta, because you want your at-the-money straddle to decay faster than your long wings. Michael asks, with this low vol environment, do you minimize your credit spreads such as flies and condors? I love butterflies and condors, particularly the iron variety. So, no, I think this is an ideal environment to use butterflies and condors. Having said that, I look at the VIX and I just shake my head. It's so difficult to make money with a VIX that stays in the low teens. And it just seems to stubbornly stay there. Look at all the uncertainty we have in the world right now. From Scotland's independence to Ukraine to ISIS to everything else, and implied vol is just stuck in the low teens. I frankly don't understand it. And I'd be so hesitant to be net short vol at this level. Max asks, he trades the SPX, which is fine. It's a wide market, yes. That's why I don't like it as much as the SPY. Sometimes you get filled to the mid-price, sometimes you don't. Would a better fill in the SPY make up from the higher commissions of 10 SPY to 1 SPX? Well, first of all, that depends on your broker. But as far as I'm concerned, the biggest single cost to any trader or investor is the bid-offer spread. We are in such a competitive environment out there with brokers just dying for your business that you can negotiate, particularly if you trade any kind of volume, you can negotiate dirt cheap commissions. Now, I'm not going to recommend any particular broker. I don't have a dog in this hunt, but you can negotiate that. What you can't negotiate is the bid-offer spread. It's there or it's not. And don't forget, here's something very important. Ease of exit in a position is more important than ease of entry. We used to call a position it couldn't get out of the Roach Motel. It was easy to check in, you couldn't check out. I don't like trading options with wide bid-offer spreads. The bid-offer spread is your primary cost. The bid-offer spread can turn a winner into a loser just because you had to buy the offer and sell the bid. How can one, do I have a broker of choice? I use Thinkorswim because I like the platform. Other than that, I don't really want to get into recommending anyone in particular. There's a lot of good ones out there. Option Express is good. IB is good. I use Thinkorswim just because I like the platform. Rich, how can one tell if premium being paid is more than the usual premium for a particular stock? I imagine you make particular options. I trade certain options on certain stocks, so I know what the average premium is. The new stock comes up, I don't know if I'm really paying far too much. Well, if a new stock comes up, then you really want to watch it for a while, and you want to take a look at your price history data. And if you do an option spread, paying too much or selling too cheaply is almost a moot point, because you've done a spread, so you know what you can risk and you know what you can lose. Just found email. Yes, there will be a link to the recording. Rudy asked my top 5 option instruments. I like the SPY. I like the Russell. Those are my favorite 2 index options. I like the VIX. I'm actually long of VIX vertical calls. I'm long the October 15-17 vertical call spread in the VIX, just because I think, VIX in the low teens, I don't think it can stay there. But hey, what do I know? So I like the VIX, the SPYs, the Russell. For individual stocks, I like Apple quite a bit. I like Netflix quite a bit. And for just cash-secured puts, I like AT&T. AT&T has a really high dividend. With interest rates at these ridiculous levels, I really think you should pay more attention to dividends. AT&T has a dividend yield of better than 5%. So, it's an ideal stock for a trade like a collar. Greg asked, do I prefer SPY or IWM options and always avoid leveraged ETFs. Always. Stay away from that triple short or triple long stuff, which is why I say trade VIX, not VXX. Leveraged ETFs are flawed products. They're also manipulated. and they don't exactly track what they say they're going to track. If we had regulators worth the name regulators, those things wouldn't even be around. Okay, I see people are starting to cut out here. Oh yes, and Greg reminds everyone, VIX as well as VXX expire on Wednesdays, not Fridays. Thanks, Greg, for that. That's a good reminder. Good reminder that people know it's the third Wednesday of the month, not the third Friday of the month. This is because the CBOE makes their calculations on Wednesdays instead of Fridays. By the way, historical fact, do you know why options expire on the third Friday of every month? Because that is the day of the month with the fewest chances of a holiday. So the fewest chances the market will be closed. Lyndon wants to know more about the options room. Okay, the options room is gonna be like this. The options room is, I'm gonna be here pretty much bell to bell, not always. I'm gonna be here with a couple other people. We're going to do a screen share. I'm actually gonna throw up my Thinkorswim page, and we're going to look at the market together, and we're going to talk about the market and what the options market is telling us. The options market tells you things, and the savvy trader can find that. We're going to talk about it, and I'm hoping it's going to be a little controversial. I mean, Danny just said he's a bull. Well, I'll tell you what, I'm a bear. I always think the market's going down. I always think the glass is half empty, and I'm much more comfortable being short than long. So we could probably argue about that. Anyone out there who really thinks this rally makes sense can tell me I'm full of it, etc. So I want it to be entertaining, and I want it to be informative. And I also want it to be controversial, as well as entertaining. And for instance, here's something else that's going to be true in the options room. Remember, I just talked about these three-dimensional options trading. So if you're a subscriber of the options room and you ask the room or ask me, I think Facebook is way overpriced. It's going to stay here for a little while, and then it's going to drift lower. Well, I'll show you an option strategy for that. Or if you think, you know, we're going to go down till Thanksgiving, but we're going to have a year-end rally that'll take your breath away. We can discuss a strategy for that. Sort of like the Ask Randall show. All depends on Yellen, says Driss. Yeah, pretty much. And Charles, yes, well, please check out my website, folks, www.thelissreport.com. I hope to see all of you in the options room, and if you would like more webinars like this, well, tell Danny. I do a zillion of these, and I enjoy it. And it's 11 o'clock, I see, or nearly enough. So I'm going to wish everybody there a great weekend. Goodbye.
Hold on, you guys. All right, you guys. It was a really great webinar, and you know what? Randall's the kind of guy that I like. He's straightforward. He may be a little brass, but he knows what he's talking about, so he can be that way. Now, the thing that I want to talk to you guys about now is about our options trading room, and this is going to start up on the 29th, but what we want to do is we want to make a special offer to you guys. And that's the link that we just put up just there that Randall just posted. That will get you into the room for a total of $29. It's $129 a month value. And I'm going to tell you what, if you do it quickly, if you do it today, this wasn't planned that way, you'll have access to all the different rooms and the boot camp that we're doing. So the intention isn't to storm the boot camp right now with a bunch of options people, but the intention is to give you guys an opportunity to look at what we're doing. It's very straightforward. You know, you get to choose your educator, and the other thing is that the two guys that are going to be working with Randall is Jamie, and he's at the top up there, and Tim Evans, and they're going to be starting to Yeah, the room starts on the 29th, but if you sign up today, you'll have access to all the rooms until the end of the boot camp, and then you'll have to transfer over to you'll be in the option room when you go in, but the way the room works is you'll have access to move around all these different rooms. Obviously, the intent is to get the people in for the options room, but like I said, it's coming right in the middle of our boot camp. Next week, we've got a full week of boot camp for all our futures traders, and Marlon, one of the partners right now, is loading everybody in. But that said, look, I love what I do. I'm excited about this. I think that there's really some cool stuff going on. I really, really like Randall. I think Randall's cool. I mean, I knew it right away when I met him. And I think the way he teaches is kind of the way I like to learn. I like somebody telling me that, hey, this is the way it goes. You know, I don't know enough about options to have, you know, I'm more about educated guesses than being educated. But the 30, yeah, well, what I'm saying, the 30-day trial will, if you sign up today, we'll make it so that the trial will start today. It will last the 30 days and the extra days for the boot camp. So you'll be right in there. Now, I've asked Randall. I don't know if Randall's going to, I told Randall that, you know, there'd be an opportunity to meet you guys in the room this week if we told people they could get in, and that's what we're going to do. But does everybody have the link to that? Can you give me a yes or no? I want to make sure you got the link. And then do you guys want me to stick around and talk a little bit about kind of what's going on in the markets? I guess that's a yes and a no for both questions. What Marlon, that's our partner. In other words, you won't be charged until the 29th. You'll be able to get into the room and check everything out.